Hello everyone, I'm Robert and I will talk about a few things regarding the importance of corporate bonds, credit rating agencies, bankruptcies, the equity market, and raising capital. Without further ado, let's get ready and dive into the information. When companies need funds, one avenue is the corporate bond. It's not just a certificate but a commitment. The company promises to repay borrowed funds with interest. Investors, from individuals to large institutions, buy these bonds, essentially lending money. It's a win-win. Companies get the capital they need, and investors earn regular interest. Let's break it down. A company decides the amount they need, the interest they're willing to pay, and the bond's lifespan. Once they issue these bonds, and investors buy them, the clock starts ticking. Over its lifespan, the bond accrues interest. When it matures, investors get back their initial investment. Now, how can an investor trust a company's promise? Here's where credit rating agencies play a pivotal role. Think of them as the watchdogs of the financial world. By evaluating a company's financial health and its ability to repay debt, they assign ratings. Higher ratings signal better creditworthiness, often leading to more investor trust. But these agencies can be a bit biased, based on who's primarily funding them. But even with safeguards, sometimes companies face hardships. If a company goes bankrupt, there's a hierarchy. Bondholders, being creditors, usually have a higher claim on assets than stockholders. It's not a guarantee, but it's a protective layer for bond investors. Moving to the equity market, it's the vibrant space where company shares change hands. By buying a share, you own a slice of the company. Unlike bonds, there's no promised interest. Your gains rely on the company's success. It's riskier, but the potential rewards can be substantial. Behind every product or service is a company's need for funds. Capital fuels dreams, innovations, and daily operations. Companies weigh options. Should they share ownership by selling stocks or borrow through bonds? The choice depends on their strategy, market conditions, and future projections. Every company's journey to growth is paved with various stages of financing. Like a tree that needs the right nutrients at different growth phases, companies too seek diverse capital sources as they mature. Seed capital: picture a budding entrepreneur with a game-changing idea but limited funds. At this nascent stage, seed capital comes into play. This is often sourced from angel investors, individuals who believe in the potential of an idea and are willing to take a high risk for possibly high rewards. Venture capital, VC: as the company starts to show promise and requires more substantial funds to scale, venture capitalists enter the scene. These are professional groups managing pooled funds from many investors to invest in promising startups. In the early stages, they're not just investing money, they often provide mentorship, industry connections, and strategic guidance. Private equity, PE: as the company matures further, needing larger infusions of capital or strategic restructures, private equity funds step in. Unlike VCs, which often bet on early-stage companies, PE firms typically invest in established companies. They aim to optimize operations, drive growth, and eventually, after increasing the company's value, seek an exit either through a sale or other means. Initial public offering, IPO: the crescendo of this journey for many companies is going public. An IPO allows a company to sell its shares to the general public, often raising substantial capital. This move provides liquidity for early investors and alters the company's financial landscape, introducing public shareholders into the mix. Throughout these stages, each capital infusion isn't just about money. It's a validation, a strategic partnership, and a stepping stone to the company's